Morning guys, Joel Frank here, market analyst for YouTrading. This morning we're taking a look at Eurodollar. So why don't we, before we talk about what's going on right now and the technicals to look out for right now, why don't we just take a quick look at some of the recent price action and sort of recap what's been going on in the last couple of months. Well, if you go back to the start of the year, which is around here, which is where we hit that peak, actually, I think that might be the 6th of January annual high. The pair was on the back foot. That was as a result of dollar strength. It dropped all the way from, 123 all the way down to, where even was that though? Let's have a look. Yeah, under 117. And that, at the time, was driven by rising US government bond yields, particularly a rise in US government real yields. However, much of that move has since reversed, and that's partially, again, because of yields. Nominal yields have stabilized and real yields have fallen back again, largely because in the last couple of months, I think the Fed has surprised the market with how dovish it has been, and that has supported this recovery in Eurodollar back to its current levels. You can see, if we zoom in a little bit now, you can see over the last couple of weeks, it's been between the 122.50 and sort of the 121 level. If we zoom out a little bit, you can see this previous high from February, just above 122. We've been struggling to get back above that. We've recovered all the way from these previous March lows, but we're still struggling to get above that high. Obviously, if that high does go, the next target will, of course, be the annual high at 123. So what's been going on fundamentally speaking for Eurodollar then recently? Well, last Friday we had non-farm payrolls data, biggest data of the month, and it was an interesting report. Basically came in under expectations. About 559,000 jobs were added to the US economy in the month of May. Markets were expecting 650. If you remember, I think it was about 2 months ago, pretty much when Eurodollar was at these lows actually, about 2 months ago, markets were expecting that the US labour market would be adding 1 million jobs a month, like bang, 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 month after month, all the way through summer. And that hasn't been the case. Remember back in April, US labour market only added, 200 and something thousand jobs. Now in May, only 500 and something thousand jobs. The recovery in the labour market has been more sluggish than expected. Why? Well, there's varied arguments. Obviously, the Democrats are trying to argue that it's things like childcare responsibilities with a lot of schools not open, and fear of the virus, whilst their Republican opponents who oppose the enhanced unemployment benefits have been blaming the enhanced unemployment benefits for disincentivizing people from returning to work. But anyway, that's more of a political discussion. The fact of the matter is the US labour market recovery has been going slower than anticipated, and all of that supports the case for a dovish Fed. Now, remember, the Fed's guidance at the moment says no rate hikes until at least 2024, and no pulling back on the QE asset buying, bond buying, until substantial progress has been made on the labour market. Remember also that the Fed isn't too worried about the current spike in inflation that we're seeing in the US, because they see it as transitory. They expect inflation to fall back again. Pretty much Fed members will not be seeing the current progress in the last 2 months in the labour market as meeting that criteria of substantial progress. So definitely in the weeks to come, we do have the Fed meeting next week. I expect that they will probably sound dovish, and they will continue to push back on expectations that they'll be tapering their QE program. And I do expect this is probably going to be a dollar negative, which is probably going to help Eurodollar back to this recent area of resistance. And perhaps if inflation data comes in stronger than expected, but the Fed continues to be dovish about the labour market, about inflation, saying that they pretty much don't care about inflation in the short run, that's going to put pressure on real yields, because inflation expectations will be elevated, and that could potentially see the pair rise even further. perhaps on to that annual high. That is definitely the area that the bulls are looking to test. But yeah, guys, hope you enjoyed the video, and I'll see you all in the next one.